My name is Alex Perny. I'll be your presenter today. I'm a certified IRA services professional here at Advanta IRA. I've been doing this for close to about 8 years now. And full disclosure, I am a nerd when it comes to self-directed IRAs and retirement plans in general. So if you have questions, feel free to ask them when it comes to contributions and all this stuff. I try to make it as light and engaging as possible. So please do feel free to ask questions. Although today we will be simply focusing on some applicable deadlines that you have coming up that you need to understand in order to make sure you get some contributions in, understand where you can use your extensions to help you out with that, and then also where you do have some hard deadlines coming up as well. So before we get started today, Advanta IRA and our employees, we do not provide legal, tax, or investment advice, nor do we endorse or promote any products. All information today is provided for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. With that said, if you do have any continuing questions from today, I do encourage you to go to our website, advantaira.com. Our learning center is a really comprehensive tool that will help you with regards to understanding what you can do with us, the different events that we have, our on-demand platform, and our blog. They're all really great resources, so I do encourage you to go check that out if you do have any questions after that. Okay. So some people haven't heard of self-direction. I always like to kind of preface my presentations with an indication of why. You've been able to do self-directed since 1974 with the passing of ERISA, which created 401ks and IRAs. It's just that inherently a very small portion of the custodians in the market will allow for you to invest in the things that you really like. Now, that doesn't have anything to do per se with the actual contribution limits that you're going to be limited to, but it does have some bearing on what you can invest with. We specifically focus on the alternative assets, so things like real estate makes up about 60% of the assets that we administer for our clients, private placements, private stock, mortgages, really anything that you can think of, so long as that it is permissible to do within an IRA, we can handle. And even though this is going to be focused on contribution limits, I do like to let people know that the two things that you cannot invest in are going to be insurance, life insurance, and collectibles, and you cannot buy anything from a family member except for brothers and sisters. So you cannot buy or sell anything to a mother, father, son, daughter, essentially anyone directly up and down from you in your family tree. Just like to get that out there so that way that some questions in case you are a little bit new to this can get answered as well. Now, what type of assets can you purchase with a self-directed IRA? Again, it is as varied as the day is long. It's a lot easier for me to tell you what you cannot invest in than it is for me to tell you what you can invest in. Now, today we're going to be focusing on a couple different kinds of plans. The traditional IRA, the Roth IRA, the simple IRA, and the SEP IRA, because they're going to have the most applicable deadlines to you as far as your tax filing and the like. I'm not sure why it keeps advancing on us right there. So with regards to this, the most common two that you're going to be running up against right now are going to be the traditional and the Roth IRAs. The traditional IRA is going to have a contribution limit of either $6,000 or $7,000 this year. So you do get a little bit of a bump from last year, which is nice, although $500 doesn't make up for a whole lot of things with regards to cost of living adjustments per se, because we haven't had a cost of living adjustment with regard to our contribution limits since the taxable year of 2017. So it's been 2 years, but at least we got one with the new tax laws. Now, those new contribution limits are going to be $6,000 and $7,000 respectively, and the bump for the $1,000 catch-up will be at the age of 50 and a half. Now, the SEP IRA and the individual 401k got a slight bump as well, and the simple IRA, although it is not being phased out, did not get any applicable bump to its type of contribution limits. And just checking, it doesn't look like we have any additional questions so far. I do encourage you to ask questions. Again, this isn't going to be something that might be question intensive, but I do like to make sure that we get them answered. Advance. Okay. So With a traditional and Roth IRA, some things that you need to understand when it's coming up to your contribution deadlines. Your contributions are going to be limited to $6,000 if you are under the age of 50 and a half and $7,000 if you are over. They are going to be made up of earned income. Now, what does that exactly mean for you? So earned income is going to be income that is qualifying for FICA, Social Security, wages, and that can be from a number of different sources. The main thing to remember is that it cannot be passive income. So your Social Security check, if you get Social Security benefits, do not necessarily qualify for making an IRS or for making an IRA contribution. Conversely, things like dividend payments, your royalty payments, things like interest on a money market, all those kind of things that can certainly be considered as income, and then you do certainly have to pay taxes on, aren't going to qualify you for your IRA contribution. So you really need to look at it as what you're going to be earning in as what's typically considered W-2 wages in order to make those contributions into these types of plans. Now, the nice thing about this is that the contributions are not any type of basis within earnings. So your earnings are going to be unlimited with these types of plans. It just has to do with the amount of money you can take out of your personal pocket and put into one that is going to be limited. So if you're someone that anticipates to make more than $7,000 in an IRA, you don't have to worry. This is just what you're taking out of your personal pocket and putting in there, not necessarily anything based with the returns that you're making on those earnings. Now, depending on your household, one spouse may or may not make enough money to have the amount of income to contribute the $6,000 or $7,000. That doesn't necessarily matter. Some people call it the spousal IRA or spousal contribution. From the eyes of the IRS, when you're filing a joint tax return, you are essentially one entity. It doesn't necessarily matter whom is making what money, you're paying the same taxes as a household. Marrying couple filing jointly. Now, this can be anyone that is legally married, so that does apply to same-sex couples as well. So what you need to understand is that if one person in a legal marriage is not working or does not make the $6,000 or $7,000, but the other one certainly does to be able to contribute, you both can contribute to that plan. So if you have a married household, your contributions are going to either be $12,000 or $14,000, depending on the age of each individual. Now, it does not go by the age of the oldest individual in the household. It is each individual's age, which you can use both of those incomes to justify the contributions into each respective IRA. Now, the cool thing with this is that you don't necessarily have to have a lot of income. There's a lot of tax planning strategies that kind of center around the ability to have income that is as low as possible in certain areas, so that way that you manage that way you reduce the amount of taxable exposure to things like Social Security. Obviously, the more taxes that you're exposed to, the more money you're going to have to pay, which is typically something that people try to get away from. So if you can get it to the point where you are, as a household, showing earned Social Security wages as, let's say, a total of $14,000, you could still make the full contributions for each of you, even if you had dividend income or passive income that well exceeded that for tax planning strategies. We had a question that came in that asked, what about LLC income? Now, that is a great question, but it's not something I can necessarily answer, and not for lack of wanting to, but it's really hard to say, because when you say LLC income can be W-2 income. You can get W-2 income from an LLC. Me, Alex, over here at Advanta IRA, I get W-2 income from Advanta IRA LLC. Most of the time, what I'm assuming that question is centered towards is something like a distribution to a member or another type of more passive income. The thing you need to look at with regards to income from entities is whether or not that income is going to qualify for minimum required taxes, such as FICA or minimum required Social Security withholding. If it does, then typically yes. Another easy way to kind of look at that, or I should say easy, but we're talking about tax schedules, is that if you realize that income from the LLC on Schedule C of your 1040, which is earned active income from services provided, then yes, typically. But again, you need to check with a tax advisor to determine exactly how you're realizing that income, as to whether or not that is going to be a valid way to contribute to that account. Now, Roth and traditional IRAs also have kind of an interesting caveat in that you can have both, you can contribute to both, but your total limits are going to be the $6,000 or $7,000 this year. And I really should preface this: the main deadline that you have for this is April 15th, your timely filing deadline for making prior year contributions, and those prior year contributions are reduced by $500 on each. So $5,500 and $6,500 respectively are your maximum contribution limits for this type of plan, so traditional and Roth IRAs for previous year, that have to be made by April 15th. Now, getting back to my current point is that traditional and Roth IRAs, you can certainly have both, you can contribute to both, but you cannot have an aggregate total contribution to these plans in a given year for yourself as an individual that exceeds $6,000 or $7,000 this year, or $65,000 and $5,500 for last year, meaning that as great as it is to have a Roth and traditional IRA, you can't double dip and contribute fully to both of them, even if you have income that would qualify you to do so. So the nice thing about this is that even if you did not have an IRA last year, you did not have one open, you can still open one this year. You have to have it open by your filing deadline in order to make a previous contribution for last year, but you still have time to do that. So let's say you're just now getting into tax planning, you're realizing that the new tax law is not as beneficial as you thought, and you need to get some more deductions, so you need to open up a traditional IRA to make some contributions into. Great, you still have time to do that. So long as that you get the account open and everything postmarked by the 15th, we can still get an account open and get that done for you. And you can still claim that as, and we can still get it reported for last year, and you can claim that on your taxes. So it's a good thing to know is that you still have a little bit of time with these plans. And again, these plans are the ones that have the really, the really sharp deadline, if you will, that is coming up. Now, individuals that are over the age of 70 and a half cannot contribute to a traditional IRA. Even if you have earned income, unfortunately, for those individuals that are of that age, you have reached that limit. And there is nothing that we can really do for you with regards to contributing to get a deduction for your traditional IRAs. Now, if you turn 70 and a half in this year, you can still make a previous year traditional IRA contribution. That's fine. But going in this year, it's the restriction on being able to contribute to a traditional IRA is going to be the year in which you turn 70 and 1/2. So if you turn 70 and 1/2 on January 1st, you can still make a full traditional IRA contribution for last year before your filing deadline this year. It's the year in which you turn 70 and a half. So just keep that in mind. Even if you still are a wage earner, you cannot contribute to the traditional IRA anymore, which is money out of your pocket. Not to mean that you cannot make earnings, not to mean that you cannot do rollovers or transfers. It just has to do with the fact that you're going to be restricted on that direct contribution to that plan. All right, let's do advance. There we go. Okay, so SEP IRAs. Now, something we need to understand about SEP IRAs and to a lesser degree of simple IRAs is that you do have a little bit more time with these, but if your financial year, or if you have tax planning centered around certain dates, some people have them shorter or longer, you might have some very pertinent deadlines to meet if you're trying to calculate contributions for these types of plans. So a SEP IRA stands for Simplified Employer Pension IRA. Now, this, in the most simple terms, is a traditional IRA on steroids. This is going to be an all-deductible plan, meaning that there is no such thing as a Roth SEP IRA. You can convert a SEP IRA immediately after making the contributions, but there is no such thing as a Roth SEP. So the contributions for a SEP are going to be limited to $56,000 for 2019 and $55,000 for 2018. Now, this is going to be based on 25% of your total salary, so your your W-2 wages that are going to be paid to you, you can defer into a SEP plan. Now, excuse me, when I'm referring to this, I'm typically referring to our clients that are interested in this as sole business owners that are owner operated or are sole proprietors or self-employed individuals. These things can scale very readily, very large, but you do need to understand that these contribution limits are going to have some other rules that are applied to them with regard to treating people equally. I have a presentation on our website about 401ks and choosing the right employer plan that kind of goes into more detail about how to get into the nuts and bolts of figuring that out to a very specific degree. Now, with that said, you can contribute two parts to this. So a SEP IRA really has two parts. You have a traditional IRA with a SEP portion. When I talk about the $56,000 or the $55,000, now that is going to be an addition to your traditional IRA contribution into this plan. So you do get another kicker on top of that, which is your traditional IRA contribution to the SEP plan. Now, the one downside to the SEP plan is that unlike the solo 401k that we'll get into in a moment, you do have to have very high wages, which I guess is a good thing. Most people, I think you'd be hard pressed to find someone that would not want to have $270,000 a year of compensation, but you do have to have very high earned compensation in order to maximize a SEP contribution. Now, this is an interesting fact because for people that have this level of income, typically there's a lot of tax planning strategies involved. And when I say that is that most people that are making this amount of income, which I hope everyone here is, are going to be doing a lot of tax planning strategies, trying to not show that you're making 270 grand as earned income, but that's not always the case. People that have large commission jobs or particularly realtors in general, typically this works well for, have higher earned income that they have to pay those taxes against. So a SEP plan works really well for that. And the nice thing for a SEP plan is that if you're a sole proprietor or a self-employed individual, and a lot of realtors are done as contract for that purpose, the contributions that you make to these plans create a corporate deduction and a personal deduction. So the deduction for making your SEP contribution is going to be seen twofold. The 56 or 55K that you're making as a salary deferral contribution kind of has a couple different parts when you're looking at how it relates to your deductibility on your taxes. One, it is a reduction of salary. So you're taking your total amount, 25% of it, putting it into the plan. That reduces the amount of taxes that essentially you have to pay because you're showing less income. Now, if you are a self-employed individual, or let's say you're filing as an S Corp and you get to completely pass through the tax benefits, you can create large amounts of personal deductions because you get to pass on that corporate deduction to yourself personally in some cases, and then also take the contribution for your traditional IRA, and you get to show the reduced amount of income as well in that given year. So there are some pretty creative tax planning strategies centered around the SEP IRA. Again, you do have to have high compensation of earned income in order to make this work, but there are some ways to be pretty creative with it. Again, get with your tax advisor on exactly what the best route for you to be, and that would certainly help determining that. Okay. Okay, good. We got a good question that just popped in here. So Scott asked if he understands me that a non-working spouse, so long as you're filing jointly, can make a contribution from the working spouses to their IRA. It's still in the name of their IRA. So let's say, let's say my wife Rachel did not work. She stayed at home. If we had children, if she stayed at home with them, or for whatever reason she did not have earned income, and I worked, or vice versa, we would just open up a traditional IRA for her or a Roth IRA and make a contribution out of our joint pool of income to her IRA. Because essentially, think about it like this: when you file a joint tax return, the IRS does not see you as two separate people. It sees you as a household. So it doesn't necessarily care where the money comes from. It's just a total amount of money that you have to pay taxes on. Even though you do have to enter in your own W-2s, you do get it is either, think about it like this: the standard deduction is either married or single, because it just determines the whole amount of income that you take the deduction for. Obviously, there's way more complicated tax planning strategies than using the standard deduction, but it just goes directly into their IRA. It's not Alex's IRA on behalf of Rachel Perny. It's just my wife's IRA, put the money directly into it, and it's as if she had earned the income. She directly gets that account in her name. All right, good questions. So the rules for this it's going to be a little bit different. So with regards to figuring out self-employed individuals, it's a little bit more straightforward when you look at it from the aspect of being a company with, let's just say, one employee. And employees are typically determined as anyone over the age of 21, not covered by a collective bargaining agreement, a legal resident, and working over 1,000 hours a year for you. So with self-employed individuals, you do have a little bit additional calculations to make. Your contribution limits are going to be your contribution less 1/2 of the self-employment tax. So keep that in mind, that you do have an additional factor when it comes into calculating your contributions for a SEP plan. And you do not have to make these contributions for a SEP plan every single year. You have the election to change it from year to year. You can't necessarily change it mid-year if you have employees, but if you're a self-employed individual, you have complete leeway to essentially do as you like, because you're the one that gets to determine your own fate at that point. You don't have any additional rules that have to be applied to that. But you do not have to make contributions year to year. With a simple IRA, you do, which can be kind of a big rub with regards to those plans. Those plans, although they're not being officially phased out, this is the legislation that kind of came in to help simplify things, and also gives a little bit more benefit and clarity to some of those rules that are cumbersome, to say the least, with regard to those. And Tim, yes, there will be a recording of this, and the slides will be available to anyone that did put in a valid email in the registration. It's a lot to take in, but keep in mind, like I said, the traditional and the Roth are the big ones to keep in mind, because those are the ones that are coming up very quickly. And unless you have a financial year that requires you to do your SEP IRA contributions immediately within the next few weeks, then you're pretty good on this. Because the nice thing about this, getting to the next point, is that contributions can be made, which is say must be made by the filing date of your company plus extension. So if you file an extension, depending on when you file that for it, now if you file as a corporation or as an S corp or as a sole proprietor or as an individual, it's going to vary widely. But just keep in mind that your contributions for a SEP plan for previous year have to be made by your filing date plus extensions. So for some of you that might have passed, for some of you, you might have a long time, but the key point to take away is that you need to check when you are filing a corporate tax return as to when you need to make the SEP IRA contribution, because it is going to be different than your timely filing deadline as with the traditional and Roth IRA. The nice thing about this is that you can establish a SEP plan this year. Essentially, you just have to establish a SEP plan before the contribution deadline, before your filing deadline. You can make a contribution for last year, which is a really powerful tool, because that does not apply for 401ks. So definitely something good to know. If we can get the slide to advance. Okay, there we go. Okay. So individual 401ks. These are something that get a lot of press, and for relatively good reason. There's a lot of benefit to using these, and unlike a SEP IRA, you have the ability to not have to pay yourself a ton of money that's going to be subjected to taxes such as Social Security. As great as it is to pay taxes and maintain our roads, I think most of us would appreciate having to pay less to Uncle Sam on an annual basis for whatever reason that may be. Now, the individual 401k lets you get a lot more creative of where you take those deductions, i.e. you do not have to pay yourself a ton of money to max out these types of plans. And depending on how you file your taxes, if you file as a sole proprietor or as a sub S corp, you have the ability to pass on quite a bit of deductions to yourself personally. So with this type of plan, you have two different aspects. Even if you're a self-employed individual, keep in mind that if you're self-employed, or let's say you have an LLC, you're still technically an employee of that LLC. So you're going to be generating two types of income. You're going to be generating corporate income, which is going to be income of the LLC or the entity, the S Corp, the partnership, whatever it happens to be. Just keep in mind that there is going to be business activity income. You're also going to have pay to yourself. You're going to have wages that you pay to yourself. Now, these can be one and the same depending on how you file your taxes. And doing a 401k will require a bit more savvy or a bit more planning or a bit more advice than just doing a SEP IRA or something more simple like an IRA. But the benefits can be very powerful. Now, the reason I say this is that unlike with the SEP IRA, where you have to have that 270 grand of earned income that you're paying Social Security wages on to calculate that 25% of your compensation contribution, with this, you don't have to pay yourself a lot of money, which is great. Now, the thresholds for the contribution limits on a 401k are that you can contribute out of your own personal income, which is called your elective deferral, up to $18,500 if you're under the age of 50 and a half, or $24,500 if you're over the age of 50 and a half. So there's a $6,000 bump if you're 50 and a half with a 401k. Now, that's based on your total compensation, and you can make 100% compensation contributions, meaning that you don't have to pay yourself 270 grand and subject that to Social Security taxes and FICA if you don't need to. You can just pay yourself essentially what you need to cover your minimum taxable personal requirements on that, which are a couple grand over that. So you don't have to pay yourself a lot of money in order to be able to make that first half of this contribution. Now that's your personal contribution. Remember, elective deferral of compensation. Now you have a profit sharing match. Most of the time people refer to this as a corporate match, or hey, my company contributes 4%. Essentially what it's boiling down to is that the maximum you can contribute to a 401k as a company, now keep in mind we're referring to this as self-employed individuals, sub-S corporations, sole proprietors, is you can contribute up to 25% of your net operating income of that business. Net operating income means all income after reasonable expenses but before taxes. So you can contribute up to 25% of that into the plan, up to $36,000. Again, now depending on how you file your taxes for this business, that could be a huge personal deduction for you, or it could certainly help you reduce taxation, especially if you're filing as a C Corp and you're subjected to corporate taxes. It can create a $36,000 reduction, or I should say deduction corporately, or depending on how you file your taxes, obviously it's going to pass on to the ultimate bearer of that liability. So you have some flexibility. So you keep two different pools of this money. You have a personal deduction, you have a corporate deduction. So you have the personal amount that you take out of your personal paycheck, which if you've worked corporate America, is what you see on your pay stub, your 401k just being immediately taken out. And you can change that from week to week, paycheck to paycheck, year to year. There is no restriction on how much you contribute or don't contribute to a 401k plan if you have one. And obviously these limits are here kind of because most people want to try to maximize that deduction. All right. Now, the cool thing with a 401k is I mentioned that there's no such thing as a SEP, or sorry, as a Roth SEP. Now, with a 401k, there is. The cool part about this is that whether or not you take a deduction for that elective deferral of compensation is your choice. If you take a deduction, then it's a traditional 401k. If you don't take a deduction and you contribute this after tax, it is a Roth 401k, which is very, very cool for the fact that you can have a very high contribution limit to a Roth IRA, to a Roth 401k, unlike the Roth IRA. There's a lot of different strategies in that. Again, I could spend another hour on this slide just talking about the benefits and strategies with regards to Roth 401ks, but I'll save you that. Just keep in mind that there are abilities to make these types of plans Roth. Now, the downside of this, there's a lot of benefits to this, and I think the first left-hand part of this slide really, kind of wets the palate, if you will, for people wanting these things. But keep in mind that 401ks is not just a golden ticket to a lot of really great tax benefits. These things really work well for self-employed individuals and then companies that have probably about more than 15 employees. And the reason I say that is that once you get past having just owner operators, once you have a rank and file employee for the purposes of a 401k plan, which is going to be considered someone that is over the age of 21, works 1,000 hours a year for you, you have to cover them in that plan. And that 25% of net operating income, that is a total amount that you can contribute. So let's say you had $100,000 of net operating income for a business. That's, $25,000 that you can contribute to the 401k plan for yourself. But if you have a rank and file employee and you're electing to contribute 25% of your NOI, that number for you just got cut in half. So instead of instead of 25,000, you get to cut that in half because you have to contribute half into their plan as well. And it obviously dilutes the more employees that you have. So again, it's something really great if you're self-employed or if you have all owner operators and each person can determine how much of the NOI they would like to receive as a profit sharing match. But when you do start to have rank and file employees, it does become a little bit cumbersome, and you do have a lot of testing that has to go along with that plan for unaudited financials, XYZ. I can teach a lot about that. But to keep in mind, with kind of circling back to the benefits of this plan and the limits that are coming up, or I should say the timeline for doing this, it's not as pertinent presently. You have up until the filing deadline plus extensions to make a previous year contribution. But unlike the SEP, if you didn't have a 401k plan established in the calendar year that you're looking to make the plan available, then you can't make a previous year contribution. So you have to establish the plan between January 1 and December 31 in order to make that contribution for a previous year. So if anyone here has not had a plan established yet as an individual 401k and wants to make a previous year contribution, unfortunately, you're out of luck. If you do want to make a contribution for something like this, just keep in mind that you do have until your filing deadlines plus extensions for a 401k. But if you didn't have a plan established within the calendar year of last year, then unfortunately it doesn't have much bearing on you. Okay. So, if I report as a sole proprietor and max out my 401k in my corporate job, is the only contribution I make to a 401k the profit sharing amount? The question that was posed for that, essentially, you do have to have constructive participation in a plan to constitute a profit sharing match. Now, if you're already maxing out your 24/5 to your corporate job and you want to have a separate one to make a profit sharing match, the short of it is that you're going to need to get with a tax advisor. The long of it is potentially what's going to happen with that is that you're going to need to factor in how much profit sharing that you are getting from your company. If it's zero, then certainly you potentially could, but you're going to have to reduce the amount of contributions that you're making to that plan because you're going to have to show that you contributed something as an elective deferral. You can't just have something sitting there for the purpose of profit sharing for your 401k, meaning that if you max out the corporate one and you have a side business that certainly would allow you to have a 401k, you can't just max out the profit sharing for that. One thing I might say to you is that you might want to consider, if you have enough compensation to do so, adjust those limits, contribute some out of your personal business and then ramp up the amount of profit sharing to kind of get you to that aggregate total. Because keep in mind, with the SEP IRA and the 401k, the aggregate totals of roughly $60,000 are going to be a total across all of your employer plans. So you, unfortunately, as nice as it would be to, one, have the money to do it, and two, to be able to create this many tax deductions, you can't max out multiple employer plans. You have to have a total aggregate number, and that applies across all of the plans that you have. So to come full circle on that, yes, you do have the ability to do that, but you would need to get with a tax planner to see where you would need to adjust your contributions in order to make that a viable plan. But it certainly is something I've seen people do, but it's just not as straightforward as a kind of a yes or no answer. So I hope that that addresses it well. Okay, we got another good question here. Okay, so a person with a side job that is taxed as a sole proprietor reporting on Schedule C self with a solo 401k. There's no W-2 issued to the proprietor because the total income is less the elective proportion limit amount to the total contributions limited to the earnings. However, the income cannot be determined accurately until after the year end. Can that elective portion contribution to the solo 401k be done in the following year? And if so, how late can it be made? So the answer to that portion of the question is, unfortunately, they don't give us guidance. I say the best practice is to do it within the month following the calendar year. There really isn't any guidance. Technically, you can make it up to the filing deadline, but think about it like this. If you're going to have to go before the IRS and say, hey, my personal compensation was not factored for the given year until a filing deadline, it's a little bit harder of a conversation to have than saying, hey, we did not figure out our total profits and losses until we could calculate all of the receivables, all of our taxes and everything till our filing deadline. So unfortunately, there isn't any guidance. I say a good rule of thumb is within the first 60 days of the following year, make the deferral of income contribution to a 401k. It's just a little bit of a loose gray area with that. It's not as easy to answer as saying, yes, exactly, you have until your filing deadline timely to make that deferral. It's a little bit hard to say, and I think you can kind of see from that is that it's just not the easiest thing to say, hey, I'm paying myself in April for services provided in December of ordinary income. It's just a little bit harder to say that. A person with a side job that is taxed as a sole proprietor reporting on Schedule C with a solo 401k, there's no W-2 for the proprietor because the total income is less than the elected amount. How will the income be returned accurately to the year? Okay, good. We got that question answered. So if I report as a sole proprietor and max out my 401k in my corporate, we got that one answered as well. Good. Very tiny answer window for me on this. Okay, good. Got those questions answered. Again, keep the questions coming because it certainly does help people. You never know if the question that you ask might help someone else. Again, so just to recap, 18.5, 24.5 are the amounts of personal compensation that you can add in. You can add in 25% of the NOI to a 401k on an annual basis. You have until your timely filing deadline to make the contributions to this plan. There isn't as much guidance on the elected deferral. It's typically a best practice to make that as soon as possible, and the profit sharing can come later if you are doing this as a solo K. You do have to have the solo K established within the given year in order to contribute for the previous year. So if you did not have one for last year, unfortunately, you are out of luck for making a contribution for a previous year, but you still do have time if you did have that plan established. Okay. Simple IRAs. Not going to spend a ton of time on this because they don't apply to a ton of people, but it is good to know that they exist. Simple IRAs, a savings incentive match plan for employees. It is a very bad name for a very complicated plan. There's a reason that the SEP IRA exists, and it is because this plan is rather complicated and cumbersome to administer. However, it does still have a place, and the typical place that we see these plans being of benefit is for people that have seasonal employees or people that may not want to participate but might have to participate if they were in a 401k or other type of plan. So as callous as it might seem, as it makes it easier to exclude people from the plan, it is a very valid tax planning strategy, and depending on how you realize your income and how you employ people, a simple IRA might be very good for you. So people that run I have some clients that run beach rental places that have high school kids that work there in the summer that obviously don't want to. They'd rather have all of their paycheck, don't have much of a need to, and it's going to be an additional encumbrance on the employer because they're not trying to retain them with a retirement plan to offer it to them. So just keep in mind that the simple IRA, if you operate a business like that has high seasonal employees or people that don't want to participate, it might be a good fit for you, but those people typically can be well served by a SEP. So the elected deferral limit for a simple IRA is $12,500 per year per employee, with a $3,000 catch-up if your employee is over 50. Company contributions are either 2% non-elective of each employee's compensation or 3% matching of each employee's compensation. So you can see how that kind of can vary a little bit. So you either have an elective or non-elective. You have non-elective match or a scaling match for that. The plan must be established by year end to make contributions in that year. So if you didn't have one last year, you cannot make one for this year, but you do have up until your filing deadline later this year if you file an extension for this. The bad part about this is that if you make a 2% non-elective contribution election, then you have to make that 2% election for 2 straight years, or if you make a 3% matching, you have to make that for 2 straight years. You cannot change, dissolve, or alter a simple plan for 2 years unless you want to pay severe penalties to the IRS. So it's a very inflexible plan. After 2 years, you can have your way with it, but it's just not something that's a really good fit because with the dynamic marketplace that most people operate in, with regards to income, employees, compensation, it's kind of hard to lock something in for 2 full years for this. So again, they're limited, and that change does involve being able to transfer out of a simple plan. Not only do you have to maintain it, but you can't touch that money if you wanted to roll it over to another employer's plan, or if you wanted to change the type of plan, you're stuck in it for 2 years. So it's a big commitment for that. And you do have to include all employees who make over $5K a year. So it's not necessarily based so much on hourly work, but it's the amount of money that you pay them. And there's just a lot of regulations that cover these plans as well. So okay, I got another question coming in. I have an S Corp. My accountant has been advising me previously that it was better for me to invest in a SEP IRA for me and my wife, also an employee of my S Corp, rather than invest in the traditional Roth IRAs as the limits are higher. But the individual 401k is better for us than the SEP IRA. But is the 401k better for us than the SEP IRA? You suggest that we can make those contributions without the need for W-2 payments, saving us on FICA payments, essentially similar to shareholder distributions that go into individual 401k contributions. Great question. Unfortunately, the rules governing 401ks is that you would have to include your employee. So you and your wife certainly can be covered by the plan, but you have to offer that plan to the employee. Now, there's some additional expenses with that. Once you do have a qualifying employee, you're also going to have to do what's called discrimination testing. So you're going to have audited financials of the 401k, which is an additional expense. If you take the net operating income of the business and you want to make that contribution, keep in mind that 25, let's say it's $100,000 of NOI for that business, you have to divide that by 3 now because you have to treat everyone equally with that profit sharing. So having that additional employee in there is going to kind of cut into that. Now, yes and no. I love the solo 401k. I truly do, besides, wanting people to open one with us, I, in a more general sense, really believe in that plan. That is a very big benefit, and the government is actually giving you a huge tool, especially for the self-employed individual, to make a lot of tax savings and really benefit yourself very well. But it's one of those kind of things where it just doesn't scale well for the small business once you have rank and file employees. Now, the SEP IRA might just be a better fit because you have the ability to kind of scale how much you're putting in there by how much you're paying each one of the. So it is just you and your wife. So if it's just you and your wife, then yeah, if you don't have that employee, then yeah, it can certainly be a very good benefit to you. give me a ring, shoot me an email, and we can kind of go into the more nuts and bolts and the details of that afterwards. I'm certainly happy to set up a consultation and kind of go through that with you. But yeah, if it's just you and your wife, it can still be covered under a solo 401k plan document. You do not have to do discrimination testing and have third-party audited financials for it. So yeah, it's certainly something that might be a definite benefit to you. Again, your tax planner is going to be the one that needs to advise you, and the SEP IRA might be the best fit, but we can certainly go through how a solo 401k might fit into that for you as well. Here's just everything enumerated. I like to put this up so that way when I email out the slides to people that want them, they at least have this to reference back on it. I also include the ESA and HSA contribution limits on there as well. And getting started with this, as kind of a canned slide as this is, it is easy. You just need to open the account and fund it. There isn't really too much that goes into that. It's just some basic paperwork that you need to complete for us, or anyone for that matter, for 401k or IRA contributions. It's really not that terribly complicated of a process. That we just provide you with deposit instructions and you can get those things in there. So just to recap, everyone, please make sure that you notice that the hard deadlines that you have are going to be for your traditional and Roth IRA contributions for last year. You have to have those postmarked and in to us by the 15th. So if you put a stamp on an envelope and take it to a post office and they put a postmark on it by the 15th, you're still good. But you do have to have that in there. If you postmark it on the 16th, no good. Traditional and Roth IRAs. If you file your corporate taxes at an earlier date than an extended deadline or the corporate deadline, and you file those earlier, you do need to have SEP and 401k contributions in there, because you cannot make those after you file your corporate return for that. If you are looking to establish a SEP plan, you do have until your extended filing deadline, if you do file for an extension, to establish that plan and make a previous year contribution. Simple IRAs and solo 401ks have to have been established in that given year in order to make the contribution for a previous year. So if you did not have one last year, unfortunately, you cannot make a previous year contribution. But if you did, you do have until your extended filing deadlines. So with that said, I did run a little bit longer than I thought, but that's good because we had great questions. I thank everyone for attending. I really enjoy giving these presentations. I hope it came across in the information that you received. If you have any other questions, feel free to reach out to me directly. My phone number and email are right here. I hope everyone had a great year last year and is looking to have a wonderful one this year. And hopefully we can help you make some good tax decisions and good investment routes with regards to the services that we can offer. So with that said, I hope everyone has a wonderful weekend and have a great day.